On today's video, I want to talk about the Crypto Volatility Index. Here is what I'm going to focus on in this video. So first off, I'm just going to explain what the index is and the overall project and what it's trying to accomplish. Then I will give you a background on who is actually behind the project and some of the latest updates to do with the project. Finally, then I will show you how you can actually use this Crypto Volatility Index to your advantage. So I'll give you a practical example as well, just so you can completely wrap your head around it. I will leave some timestamps below if you want to skip through any of the parts that you're not interested in. So let's get started. Firstly, what is the Crypto Volatility Index? Basically what this index is, it is a measure of expected price fluctuations in cryptocurrencies in the very short term. In the world of stocks, a volatility index is commonly used by investors to gauge what the sentiment is in the market and the overall market risk. The volatility index in the stocks world is most commonly known as the VIX, and it also goes by the fear index. You often see headlines of caution whenever the VIX index ever goes above 20 that there could be an impending bearish period. Generally, but not always, whenever the volatility increases, i.e. the VIX goes up, then stocks go down, and vice versa. For that reason, it is often used by some investors to either profit from a sharp market crash or else to hedge against losses on their investments. However, up until recently, nothing like the VIX index actually existed in the crypto world. That is what the CVI, the Crypto Volatility Index, is trying to achieve. It is a completely decentralized version of the VIX for the crypto world. The CVI value is computed from option prices and market expectations of volatility. The guys behind this project are the same guys that are behind the project COTI, which is one project that I also really like. And they are going to be first to market with this type of project. It will be the first Crypto Volatility Index. One good thing that they also have on their side is that they have the original creator of the VIX Index, Dan Gillai, on their board of advisors. Before I go on to explain how you can actually trade the CVI, I want to just briefly explain the governance token for the CVI project, which is called Govi. The CVI includes a decentralized governance component, so any holders of the Govi token will be able to vote on matters such as leverage used, platform fees and tradable assets. You can purchase Govi tokens on Uniswap, and you can also get Govi tokens by opening a position on the Crypto Volatility Index. So if you take a position on the CVI thinking there will be an increase in volatility in the short term that you want to make a profit from, you will also receive Govi tokens whenever you open that position. This will become a lot more clearer later when I go through the practical example. Before I go on to that practical example, I just want to talk about some updates that are coming down the tracks also that I think you should know about. Govi 2.0 is due to be launched soon, which will bring some much needed improvements to the overall platform. The first update is they will be adding a layer 2 solution. This is to get around the crippling fees that we are seeing on Ethereum at the moment. So if you want to actually open a position on the CVI, you actually have to make a few different trades. And the gas fees aren't long building up to being very expensive. And it makes taking out small positions on the CVI almost uneconomical. For this layer 2 solution, I believe they are looking at the likes of Polygon. The second update will bring the ability to actually trade on margin, which is currently not possible. And thirdly, they are going to launch a volatility token, which will make it a lot easier to actually take out a position for or against volatility. Okay, so now I think we're all ready to go and have a look and see how this actually works in practice. Okay, so the first place you need to go is come over to cvi.finance. So there you will be able to actually see the Crypto Volatility Index. So just to give you a bit of more background of how the actual index works, so it can fluctuate between two different numbers. It can go to a maximum of 200 when there's a lot of volatility in the market, and as low as 0. So they are the two extreme points on the index, but it generally fluctuates in around the middle here, say between 75 to 150. So as we can see here from the chart, whenever there's been a huge actual crash in the likes of Bitcoin and Ethereum, we have seen a huge spike in the volatility index. So we saw a huge spike there in January of this year, and again there lately with the whole Elon Musk saga and all that kind of fudge that was kind of piling up on us. So this index score is just created from Bitcoin and Ethereum option prices and expectations of market fluctuations. You'll be able to see here down on the left as well the total value that is currently locked up on the platform that has been traded. So at the moment it's quite low. There's only $4 million actually locked up on this index. So if you want to then take out a position on this index, what you need to do is first off is connect your wallet to the platform. So you can do this by hitting the connect button here on the top and connecting your MetaMask wallet or whatever you have. Once you have that connected, then all you have to do is go and select buy here or sell, depending on what direction you want to actually trade the volatility. So you would be buying a position if you expected some volatility in the short term. So at the moment you can take out a position either using Tether or ETH, but COTI will also be added soon. I'm just going to take you through a practical example here now, but just before I do, just the fees are going to be based on this collateral ratio that you see on the right hand side here. So just to explain this collateral ratio, the collateral ratio is the ratio between the potential maximum open positions when the CVI is 200 versus the amount that is locked up on the platform at the moment. So basically the fees are going to get a lot higher the higher the volatility is. Here is just an example so we can put some figures on it all so it can make sense. So let's say the CVI index is currently valued at 60. And the collateral ratio is at 60%. So the collateral ratio is this ratio that I was showing you there a moment ago. So that is currently only at 12%, but for this example, we're just saying that it's 60%. At this time, you want to purchase a position using 100 Tether, which you plan on selling 2 days later. So you expect there's going to be volatility within the next 2 days. So this is what will happen in practice. After you purchase, your position value will be worth 99.7 Tether, since there's a purchase fee of 0.3%, so that is taken off straight away. During the 2-day period, you'll also pay a funding fee of 10.36 Tether, which is 5.2%. So that would bring your position down to 89.34 Tether. So this is very important to know. You can't take out very long positions on this index because they have this funding fee which is charged every day, and that funding fee will depend on what position the volatility index is at. As we can see here, if this person actually kept their position, it would be charged 5.2% say every day, and that will slowly whittle down your position. So now let's look after 2 days, assuming the CVI suddenly went up to 120. So it's gone up from 60 up to 120. So it's after doubling. This will bring your position value to 178.68. So that is double the value of your 89.34. So then you're happy, you're after making a profit, you want to close out your position. Then you will have to pay a 0.3% selling fee again to close out your position, which is another 0.53 Tether. And that will then leave you with a profit of 78%. I will leave a link to this guide here in the description section. This will basically show you how to open and close a position. So this section here of the document just shows you how to sell out of your position. And lastly, what I just wanted to show you as well is whenever you actually take out one of those positions on the CVI, you also earn these Govi tokens, as I mentioned earlier on in the video. So once you've actually closed out your position, you will then be able to go to the claim tab and select the token you have bought your position with that you want to claim the Govi reward for. So then all you have to do is click claim and the Govi tokens will be sent to your Ethereum address. And so this is what the claim screen looks like on the platform. So I hope that example makes sense. That's pretty much how it works. I think the key takeaway there is if you are taking out a position on the CVI, you don't want to take out a very long position. You just want to be able to pick out a point over 2 or 3 days when you think there's going to be a spike in volatility. So you might pick out at a point where, say, Bitcoin or Ethereum options might be expiring because there tends to be a lot of volatility around then. Or even lately, as we were seeing, there's always a massive drop in the price of Bitcoin when it comes to the weekend these days for some reason. So maybe you could take out a position for the 2 days over the weekend and see if you can make a profit. Overall, the project is not fully where it needs to be at the moment, but I think in the future it's going to be very handy for investors to either try and hedge against some volatility or else to profit from it. Because we need to have these kind of things if crypto is going to be fully adopted in the future. We need to be able to do the same things that we can do in the stocks world. So I really hope you guys found this useful. If you have any questions, please let me know in the comments. If you liked the video, make sure to subscribe to my channel and hit the thumbs up button so you'll see more content like this again in the future.